Dividend investing has consistently provided investors access to truly passive income, allowing them to escape the rat race and start living life on their own terms. Yet, somehow there's always a subsection of people who will go out of their way to say that dividend investing sucks. Now, of course, everyone is entitled to their own opinion, and you are certainly free to invest however you see fit. However, dividend investing is a tried and true method that can virtually guarantee you a certain level of overall financial success, unlike many other investing strategies out there. So in this video, I will be explaining 6 reasons why dividend investing works so well, and why many of the titans in the financial industry actively invest in dividend stocks. Investors such as Warren Buffett, Carl Icahn, Michael Burry, and many others have actively touted the benefits of dividend investing. First, dividends provide returns even during a flat market. With the current global economy suffering, many economists think that it is likely that we will soon enter a recession, or even a depression. Legendary billionaire investor Stanley Druckenmiller predicts that the overall market will likely remain flat over the next decade. As an investor, Druckenmiller averaged a 30% return for his clients over a 30-year time frame. And that's 3 times the growth rate of the overall market over a 3-decade span. If he is correct, then we could see a prolonged period where stock prices do not appreciate. This could be devastating if you are a growth or value investor, as you could effectively have an entire decade where your money does not grow. Compound exponential growth is what allows investors to take a relatively small amount of money and transform it into generational wealth. However, one of the largest contributing factors to compound growth is how long the money has been able to grow and compound. If you're a growth investor and effectively lose an entire decade's worth of your money being able to compound, then you are at a significant disadvantage. If you were originally planning on being able to retire at age 65, then losing a decade's worth of growth would push that date all the way back until you are 75. If Druckenmiller is correct, then dividend investing will likely significantly outperform the broad market during the next decade of flat returns, allowing your investment portfolio to continue to grow in an otherwise flat landscape. Number 2, dividends account for a significant amount of your overall return. A recent study conducted by Hartford Funds found that over the last 50 years, a whopping 78% of the total market returns could be attributed to dividends and reinvesting those profits back into compound growth. This chart clearly shows that in the short term, the price growth of the stock itself is the primary driver when it comes to the total returns. But as the years go by, the unstoppable power of dividends and compound growth causes the dividends to be a more significant factor than the actual price of the stock itself. Number 3, not all companies can grow. If you're a growth investor, then it is obvious to you that not all companies can continue to grow larger and larger. 90% of Americans live within 10 miles of Walmart, so adding more store locations or increasing its online presence is simply not going to help Walmart continue to grow into an even larger company in any meaningful way. Many of the larger companies have a hard time growing their business because they already control the majority of the market share for their particular sector. In addition, large companies that are not actively trying to grow are typically much more established and stable companies. This means that they have a more stable financial foundation and are more likely to be able to survive an economic downturn such as the one we are currently in, that would otherwise drive many younger companies out of business and force a bankruptcy. Number 4, all companies eventually fail. Kongo Gumi was a Japanese construction company that had continuously operated for over 1,400 years. They were easily the oldest company on earth. However, even this legendary company spanning 40 generations eventually succumbed in 2006 when the company was liquidated. Most companies only last a matter of years, or perhaps decades, before eventually being forced out of business. If these companies don't pay a dividend, then you may have held stock in the company for decades and never once made any money. So while trendy stocks like Facebook can be flashy with their insane growth rates, just remember that at some point Facebook will be pushed out of business by a newer, trendier social media website. That may happen this year, next year, 10 years from now. Whatever the case is, but it is inevitable that at some point it will happen. Does anyone remember MySpace and how quickly it faded away into obscurity? Dividends can safely and easily fund your retirement. The entire goal of being financially secure is to be able to have enough money to be able to stop working at a job you hate and instead spend time doing the things in life that makes you happy, all without having to stress about paying bills such as rent or groceries. With growth or value investing, you may have years where you have generated massive growth and investment returns. However, with that type of investing, you are only as financially safe as the current economic climate. Those gains can easily be wiped out by a bad year or a few bad years. What good is retiring and quitting your job if 3 years from now the market conditions erode and your portfolio shrinks enough that you are forced to go back and start working again? In contrast, dividend investing puts money into your pocket each and every month to give you that peace of mind during retirement. There are plenty of Dividend King stocks out there that have not decreased their dividend payout in over 50 years. By holding some of these stocks, you can virtually guarantee yourself a steady stream of income during retirement. Even if the overall value of your portfolio drops, you still have payments coming in each and every month. Lastly, number 6, it changes you from a speculator into an investor. There is a certain amount of excitement about trying to find the next diamond in the rough, trying to identify the next small company that is about to make it to the big leagues. However, more often than not, the company fizzles out. I remember a few years ago when states were pushing to legalize certain green plants, there was a huge surge in interest to invest in these types of companies. As a result of this unusually high demand, these stock prices surged. However, that surge was very short-lived as the reality was not able to live up to the hype, as these companies struggled to turn a profit, let alone the cash windfall that these investors were hoping for. While hitting a financial home run is exciting, it's also pretty hard to do, especially on a consistent basis. Instead, it's usually better to play the long game and just try to get on base. Slow and steady may not be the most exciting way to invest, but when it comes to finances, it wins the race almost every time. What are some of the other benefits of dividend investing that you've found over the years? Leave a comment down below and let me know what you think. And as always, if you enjoyed this video, consider subscribing, and I'll see you all again next time. Thanks.